Welcome! Today, we're uncovering the hidden math that literally keeps our global supply chains alive.
Ever wonder why skyrocketing oil prices don't instantly bankrupt trucking companies? Well, it all comes down to clever math. Think back to early 2026. Geopolitical conflicts in the Middle East pushed Brent crude way past $105.
And petroleum isn't just fuel, right? It's actually a core ingredient in over 100 everyday products.
This kind of global shock triggers cost-push inflation, forcing businesses everywhere to jack up their final prices.
In logistics, fuel alone eats up a massive 25% of total last-mile delivery costs. Without a solid financial buffer, that extreme volatility would absolutely bankrupt fleets and collapse the industry overnight. So what's the fix? Well, industry experts like to compare the fuel surcharge to a thermostat.
When diesel prices heat up, the surcharge simply adjusts upward to keep the whole business environment stable. Basically, the fuel surcharge is an adjustable fee added to freight rates, which the shipper pays. It brilliantly balances the wildly fluctuating current fuel price against a fixed baseline in the original contract.
Let's do the math. The formula looks at current price, baseline price, and truck fuel efficiency. Subtract the baseline, divide by 6.5 miles per gallon, and boom, a 44-cent per mile surcharge.
The huge takeaway here, base rates stay perfectly stable while fully covering the carrier's real fuel spend.
So how does this actually play out? Let's trace the whole process from benchmark to final invoice.
Step 1. The Energy Information Administration publishes their weekly diesel price index. That sets our current price. Step 2. Logistics systems automatically run that index through the specific math formula in the shipper's contract. Step 3. That new surcharge is instantly applied to all freight quotes and tenders for the week.
Step 4. Shippers pay the itemized invoice, letting carriers pass those exact fuel funds down to drivers.
This protects everyone. It's a literal lifeline for solo owner-operators and a crucial margin stabilizer for massive fleets.
But hey, what happens if global fuel prices actually plunge below that baseline price?
The formula just yields a zero surcharge. That ensures nobody has to constantly renegotiate the base contract. Surprisingly, these aren't federally regulated at all. They're strictly commercial agreements that require really precise contractual documentation.
Without this math buffer protecting our supply chains, seriously, what would your everyday goods actually cost?